Welcome to the DIY Investing YouTube channel. My name is Trey Henninger and I'm your host today. We are going through every S&P 500 company. Don't forget to subscribe to the podcast and this channel to get more great content and hit that like button for more videos. We are going over AOS Corporation, second company in the S&P 500 by Alphabet. And today we're doing a 5-minute stock analysis. So let's begin with the business description. AOS Corporation manufactures and markets residential and commercial gas, electric, water heaters, boilers, tanks, and water treatment products in North America, China, Europe, and India. So it operates in both North America and the rest of the world. These water heaters go into residences, restaurants. It also distributes through independent wholesale plumbing distributors. So we have various brand name products under A.O. Smith, State, Loch&R, and water softener brands. So this is boiler, water softeners, purification units, filtration, that sort of thing. So we can immediately see that this is a pretty big company, $10 billion by market cap, with a $10 billion EV. So there's not a lot of debt on this company, it appears like, or at least it's relatively matching with cash. The beta is 1.06, so it's approximately like the rest of the S&P 500 in terms of how volatile it would be. And the share turnover is 172%, so I'm immediately saying I'm probably not interested. I tend to like low share turnover and low beta companies below 1. Let's look at some key statistics. We begin first, like always, return on invested capital. And what I immediately see is a steadily increase in return on invested capital over time. This is quite attractive. It would mean that the return on incremental invested capital is pretty high because we're steadily increasing, but it also means that it's not necessarily super stable. So I kind of want to understand what's going on here. I'm not concerned about this blip at all, but generally our current returns of 22% are attractive. The old returns of 6, 7, 8% are not. So look at our 10-year median returns, our return on asset of 11%, return on invested capital of 21%. So that does suggest some leverage with debt, at least across the 10-year period. Our 10-year CAGR is pretty good. We're growing revenue at about 7% and earnings per share of 13%. So quite attractive. That's a lot of good growth. This is clearly a growth company, something that I would be quite interested in from a growth perspective. However, your PE ratio is very high. PE of 31 is just way too high for me to pay for any company. Especially when it's only growing between 10 and 15% per year. That's not very fast growth. And you can't keep up earnings per share growth faster than revenue growth over a sustainable period. So really your stable growth is going to be closer to 7% because operating leverage doesn't last forever. So this is really too high of a PE ratio to pay. So the valuation on this company needs to be substantially lower, even with a 7% growth rate. Depending upon their payout ratio, you still want to not pay more than about a 5% earnings yield or a PE of 20. So you're about 50% overvalued at least, even for a high quality company. It appears relatively high quality with your high returns on invested capital, but they're not stable over time. And so that has me a little bit concerned about the cyclicality of this business. Selling water heaters and boilers and water treatment seems like a pretty good business overall. They're servicing both residential and commercial, and that's going to be different influences. I'd be more concerned about the companies because I think the customers are going to be a little less price sensitive here. I'd rather them be selling wholesale through distributors, which they do, and so that looks like the good part of the business there. Let's go and see if we can find out more from our balance sheet. So immediately let's look at liabilities. Short-term debt is negligible. Long-term debt, they have $106 million of long-term debt, which is basically nothing. So their long-term debt has come down a little bit over time, but it's really low debt. That's good. Pension liabilities are really low. That's also good. So I like the balance sheet a lot. Cash and equivalents is more than the debt. So again, that shows what we're wanting to see here. So the balance sheet looks really good. Income statement. Gross profit has grown pretty steadily over time, but it's only doubled in the last 10 years. It's less than ideal, but your net income is fairly flat. With some volatility in here. You can see the income's been quite volatile. So right here I'm seeing this is not really what I necessarily want to see in a company And it doesn't suggest that it's very high quality, but the shares have declined over time, so they're buying back their stock. That's always a good sign. But you can see the earnings per share have only gone from $1.66 to $2 over the course of the 10 years. And that just means, especially when you think about this means that this earnings per share growth rate is wrong, because the earnings per share are not growing as fast as what it suggests there. And the valuation is just way too high. This is a type of business you might want to pay a PE of 15 or less. It does look high quality. It's a nice manufacturing business. It is getting good returns on capital, but clearly it's being heavily overvalued at this time. So that's my 5-minute video. Thank you for listening. And don't forget to like this video and subscribe for more great content.